Welcome to the Deep Dive, your compass for navigating the markets. We cut through the noise to get you truly well informed. Today, we're plunging into the high-stakes world of STEM Inc. It's a company at a really pivotal moment, navigating a pretty dramatic transformation. We're going to jump right into two fascinating, interconnected aspects. First, the surprising truth behind BlackRock's big shift in ownership, and second, how STEM's future is now really tied to its AI-driven software. Get ready to understand the full picture behind this strategic pivot. The opportunities, yes, but also the significant challenges for potential investors.
Absolutely. STEM's recent journey, it's not just a pivot, it feels more like a forced evolution, really. You see, the company found itself in, well, a real crisis in late 2024. The alarms were definitely ringing. There was that NYSE non-compliance notice in August. It's basically a public warning, right? You might get delisted.
It's serious.
Very. And then, quickly after the CEO left, a new CFO came in. These weren't subtle signs. Yeah.
A grim picture indeed. So what was the fundamental flaw? What drove them to that point?
The old model was just, well, unsustainable. They were so reliant on selling battery hardware.
Right, the capital-intensive, low-margin stuff.
Exactly.
Yeah.
Imagine trying to run a business where revenue is like a roller coaster, huge one quarter, but almost nothing. That lumpiness, as they call it, it made forecasting impossible. Wrecked cash flow and investor confidence just collapsed. The board had to step in.
A board-led intervention, basically.
Yes, decisively.
Huh.
To force a shift towards something predictable, scalable, and, frankly, profitable, redefined as a software and services provider.
So a complete overhaul. They announced this new strategy October 2024, built on 4 pillars. Let's unpack the first one. Making software and services the absolute center. What does that really mean for them operationally and financially?
It means they're laser-focused now on predictable, recurring revenue. And crucially, high-margin revenue. This isn't just about better numbers on a spreadsheet. It's about fundamentally changing how investors see the company. Software revenue gets much higher valuation multiples than lumpy hardware sales.
Right, potentially unlocking more value long-term.
Yeah, precisely. And operationally, it cuts down that complexity we mentioned, improves cash collection, makes them less vulnerable to, say, supply chain issues.
Makes a lot of sense strategically. Okay, pillar 2, expanding energy services, consultative energy services. What does that look like in practice? Is it like traditional consulting?
It's more integrated than that. They're using these services as the main entry point for new customers. Think of it less like a one-off gig, more like laying the foundation. They use their expertise, build trust, show value up front.
And that leads to the recurring software deals.
Exactly. Building those long-term, repeatable, higher-margin software and services streams. That's the goal.
Okay, now pillar 3, this is where the AI really comes in. Enhancing their AI-enabled software and edge devices. We're talking PowerTrack, Athena.
And the big plan here is to merge them. Create a single, unified platform to manage both solar and storage assets comprehensively. And PowerTrack, which they got from the Also Energy acquisition back in 2022, that's been flagged as the commercial and strategic core. All future product development builds on that.
So building on that key asset.
Right. The aim is to unlock more value for their, 16,000 existing customers, and also attract new clients, both existing brownfield projects and new greenfield ones.
So they're all in on software. But what happens to the old hardware business? Are they just dropping it? Pillar 4 tackles this, right?
It's a completely new approach.
Yeah.
Much more disciplined. They will only get involved with hardware procurement if, 1, it's profitable for them, 2, it requires zero working capital from STEM itself, and 3, it's always bundled with their own software and edge devices.
So hardware becomes a value add, not the core business.
Precisely. And the contracts are designed for cash flow positive payments. No more balance sheet burden, no cash drain from hardware. But importantly, they're committed to upholding their existing $1.6 billion hardware backlog. They're managing past promises responsibly while making this pivot.
Okay, so it's a calculated trade-off. Short-term pay indefinitely. We saw that huge revenue drop in Q3 24 and the full year down, 69%? That must have hurt.
Well, absolutely. And it was anticipated. The whole point is to replace that volatile, low-margin hardware revenue with a smaller but much healthier, much more profitable base of recurring software revenue. Their 2025 guidance shows this shift clearly. Total revenue expected between $125 and $175 million.
But the key part is how much of that is software-driven.
Right. They expect $120 to $140 million of that total to come from high-margin software, services, and edge devices. That's the vast majority.
Revenue is one thing, but profitability is the real test here. What are the margins looking like with this new focus?
And that's where the financial logic really kicks in. They're projecting non-GAAP gross margins for 2025 in the 30% to 40% range.
Which is a huge leap from, what was it, 15% in 2022?
Exactly. A massive improvement. And just to give context, the margins on their software products like PowerTrack are reportedly in the 70% to 80% range. That's a totally different financial profile.
And we have seen some early results, right? Q1 2025 showed some tangible progress. ARR, annual recurring revenue, was up 8% sequentially.
Yes, ARR up 8% to nearly $57 million. And a CARR, contracted annual recurring revenue, that grew 7% sequentially to $69 million. These are good signs the strategy is gaining traction.
And the gross margin figure for Q1 was impressive, too.
Very. Non-GAAP gross margins surged to 46% in Q1. That's up from just 24% the year before. They specifically said it was due to the higher mix of software and services. Revenue itself was up 27% year over year, beat analyst expectations, actually, at $32.5 million. And the net loss improved quite a bit, down to $25 million from over $72 million in Q1 24.
Okay, so these aren't just small tweaks. It suggests a real shift in the underlying financials.
It does. It suggests the model might actually be working.
Now, a shift this big needs new leadership. He has over 25 years in software data analytics background from places like RES Digital, Anglo American, SLB. Crucial experience if they want to be a leading AI-powered energy software company.
Makes sense. And the new CFO, Dorenhol, came in September 2024, tasked specifically with instilling financial discipline, which was clearly needed. And they also strengthened the board with new directors bringing finance and energy software expertise. It's a full court press from the top down.
And part of that discipline involved tackling the balance sheet. That note exchange in June 2025 seemed pretty significant. Can you break down what happened there?
It was basically a lifeline, but it came at a cost. They exchanged about $350 million of existing convertible notes for $155 million in new first lien senior secured notes, which are due in 2030. Plus, they got $10 million in cash.
So the net effect was reducing debt by nearly $200 million.
Roughly, yes. Reduced debt by about $195 million, and importantly, pushed out the maturity date for that chunk to 2030. Yeah, it buys them runway. They also got a payment in kind or PIK option for the interest on these new notes.
Ah, the PIK option. So they can choose to pay interest by issuing more debt instead of using cash. Helps conserve reserves in the short term.
Exactly. It enhances liquidity, but as you said, there were costs reflecting the risk involved.
Right. What were the catches?
Well, these new notes are senior secured, meaning those lenders are first in line if things go south. The interest rates are high, 11% if paid in cash, 12% if paid via PIK. That signals risk.
Definitely high rates.
And the deal included warrants. Lenders got warrants for about 440,000 shares post-split at a strike price of $30 a share.
So potential future dilution for existing shareholders if the stock price recovers significantly.
Yes, it's a sweetener for the lenders, giving them upside potential, but it does add that dilution overhang. Still, post-exchange, their debt structure looks more manageable, maturities are pushed out, it gives them breathing room.
So what does all this mean for the path to positive cash flow and adjusted EBITDA? That's the ultimate goal, isn't it?
That's the holy grail for them right now. The high-margin software shift is driving it, but it's also coupled with really aggressive cost management. Remember that 27% global workforce reduction in April 2025? That aims for about $30 million in annual savings. Plus, they reorganized into 4 distinct business units, each with P&L responsibility.
More accountability.
Right. And the really big news, the landmark achievement, was in Q1 2025. They actually hit positive operating cash flow, $8.5 million. First time ever in the company's history. That directly tackles the old cash burn problem.
That is significant. And adjusted EBITDA
also improved significantly. The loss narrowed to $4.6 million, much better than the $12.2 million loss the year before. And looking ahead, their 2025 guidance is for adjusted EBITDA between negative $10 million and positive $5 million, and operating cash flow between 0 and positive $15 million.
So they believe they can reach or get very close to break even on an adjusted basis this year. That would be a huge turnaround.
Monumental if they achieve it.
Okay, cash position looked better end of Q1, around $59 million, plus the $10 million from the note exchange. Immediate pressure eased. But what about that dilution risk? Is it still a concern?
It's definitely still there. You have the warrants from the note exchange plus ongoing employee equity plans. And given their market cap is still relatively small, maybe $75, $78 million post-split, any future need to raise equity could be very dilutive.
And the reverse split, that was just to regain NYSE compliance.
Correct. The 1-for-20 reverse split in June was a mechanical step because the price fell below $1. Staying compliant long-term depends entirely on fixing the underlying business, not just stock price mechanics.
Let's switch gears to the technology. STEM's AI-driven edge. Can you explain how Athena, PowerTrack, and PowerBidder Pro work together?
Yeah, it's really about the ecosystem they create. Athena is the foundation. It's the AI brain. It helps plan, deploy, and operate clean energy assets, solar, storage, EV charging. It uses AI and machine learning to optimize everything in real time based on tons of data, weather, electricity rates, grid conditions. It figures out when to store cheap energy, when to sell for maximum value, or when to support the grid.
Automating those complex decisions. And
Yeah.
PowerTrack, that was the also energy acquisition piece.
That's right. PowerTrack is their flagship for managing asset performance. And critically, it's hardware agnostic. It works with different manufacturers' equipment, not just STEMs. It's proven to reduce operating costs by 3.5%, increase energy production by 1.5%. And remember, they called this the commercial and strategic core for future software development.
Got it. And PowerBidder Pro.
That's built on Athena, specifically for players in wholesale energy markets, like ERCOT in Texas or CAISO in California. You give them direct control, AI automation, price forecasting, everything needed to optimize bidding strategies in those complex markets.
Sounds like a powerful suite. Is it actually being used? Do we have examples of real-world adoption?
Oh yeah, there's solid commercial validation. Summit Ridge Energy, a big U.S. commercial solar player, uses PowerTrack for its 514 milliW fleet. Norbit Solar Farms is using it across its 50 milliW portfolio. In the wholesale markets, you've got Mercuria Energy Trading using PowerBidder Pro and ERCOT. Public power agencies like Central Coast Community Energy and Silicon Valley Clean Energy use it in PISO.
Okay, so across different segments.
Exactly. And even internationally, Neovolt's big 484 milliW solar portfolio in Hungary, that was STEM's largest software deal in Europe, Middle East, Africa that runs on PowerTrack. These aren't just pilot projects. It shows real traction.
How do they stack up against competitors? What makes STEM different?
I think the key distinction connects back to their strategy. That software-first, hardware-agnostic approach. It sets them apart from, say, integrated providers like Fluence, who traditionally bundle their own hardware and software. STEM's positioning itself as the dedicated energy AI company, the intelligence layer that works across different hardware setups. They're also protecting this, filing for that STEM AI trademark back in August 2023.
And thinking about the bigger picture, the AI boom, data centers needing massive amounts of power, straining the grid, how does STEM fit in there? Is that a tailwind?
That's a really important question. It's potentially a huge opportunity for them. Athena's whole purpose, optimizing energy use, integrating renewables and storage, providing grid stability, directly addresses the problems data centers and utilities face with these huge new power demands.
So the technology is highly relevant.
Extremely relevant.
Yeah.
While the sources we looked at don't detail specific data center contracts yet, you can easily see the fit. A data center manager needing precise control over massive power consumption. That's what STEM software aims to provide.
Okay, let's tackle the elephant in the room, especially concerning social media buzz. BlackRock's ownership. Lots of chatter, some saying BlackRock is accumulating STEM shares. What's the reality?
Yeah, this is where you see a real disconnect between institutional reality and retail speculation sometimes. The official filing, the Schedule 13 GA from BlackRock on July 18, 2025, tells a completely different story. It shows a dramatic reduction in their stake. Ownership went from over 11.4 million shares down to just about 178,000 shares.
Wow, that's a 98.44% decrease.
Almost 99% gone. A massive divestment, not accumulation.
So those social media narratives were just wrong.
Completely contradict the legally mandated SEC filing. You have to understand, large funds like BlackRock often have systematic processes. When a company's fundamentals deteriorate, like STEM's did in 2024, they often reduce exposure based on risk rules, almost algorithmically. It's not emotional. The filing is the source of truth here. Those rumors could be misunderstanding, wishful thinking, maybe even attempts to pump the stock. Always check the filings.
And the remaining 2.1% stake, does that mean anything coming from BlackRock?
Well, 2.1% isn't nothing, but for a firm of BlackRock's size, it's more likely just part of their standard index fund holdings, maybe tracking the Russell 2000 index, which STEM is part of. It doesn't really signal a strong, active vote of confidence or give them much influence.
So the challenge remains to attract new institutional money.
Exactly. Overall institutional ownership is around 27-28%, but much of it is passive index funds. STEM needs to win over active, high-conviction institutional investors to truly validate this turnaround story.
It definitely feels like STEM is a battleground stock right now. What's driving the extreme volatility we've seen recently?
Well, you have all the ingredients for a potential short squeeze. The short interest is really high, over 20% of the public float post-split. That's a lot of people betting against the stock.
And expensive bets too, right? The cost to borrow.
Extremely expensive. Borrow rates were hitting 84% to over 100% annualized in July. That puts immense pressure on short sellers. Plus, the days to cover was around 5.5 days, meaning it would take over a week of average trading volume for all shorts to buy back their shares.
And it was on the NYSE threshold list.
Yes, which indicates persistent failures to deliver shares, often linked to high short selling activity. Put it all together.
And you get that huge 45.6% price jump on July 18th, likely driven by shorts covering, not fundamental news.
Exactly. Classic short squeeze dynamics, fueled by technical pressure and retail speculation, not a sudden positive change in the company's outlook that day.
So the big question, how does STEM move beyond being this volatile trading vehicle and become a stable, long-term investment?
They just have to execute consistently, quarter after quarter. Strengthening the balance sheet was step one. The cost cuts help accelerate profitability. But to kill that trade it, don't own it narrative, they need to deliver predictable, solid results showing the recurring revenue model works.
All eyes on the next earnings report then. Q2 2025, August 7th.
That's a critical test. Another quarter showing positive cash flow, strong ARR growth, that would go a long way to validating the story for fundamental investors.
For listeners tracking this, what are the absolute key metrics, the KPIs, to watch?
You really want to focus on annual recurring revenue, ARR, contracted annual recurring revenue, CARR, those non-GAAP gross margins, operating cash flow, and adjusted EBITDA. Those are the vital signs of a healthy SaaS business, which is what STEM needs to become. They tell you if the transformation is actually happening financially.
And finally, any major external risks or headwinds we should keep in mind beyond their own execution?
Well, regulatory and political risk is always there for renewables. Changes to things like tax credits, maybe something like that, hypothetical One Big Beautiful Bill Act, could slow down the whole sector and shrink STEM's potential market. And then there's acquisition speculation. With the stock price beaten down but valuable software assets, STEM could look like a target. An acquisition might offer a premium to current holders, but it ends the turnaround story for long-term investors. Creates uncertainty.
So STEM Inc. is absolutely at a critical juncture, trying this incredibly difficult pivot from financial distress. It's a real high-wire act.
It really is. The early signs from Q1 are genuinely encouraging, though. That first positive operating cash flow is huge.
Yep.
Margins expanding, recurring revenue growing, and the debt restructuring bought them vital time.
But let's be clear, the risks are still exceptionally high. Still losing money on a net income basis, fierce competition. That BlackRock divestment shows institutional skepticism remains.
And the stock volatility driven by the short interest makes it a tough ride for investors.
Yeah.
The whole investment case rests on them executing this software pivot almost flawlessly.
Future quarterly reports are the proof points. It really boils down to a high-risk, high-reward situation. Huge potential if the transformation succeeds, but significant challenges still ahead.
Absolutely.
So here's something for you to think about. How does a company like STEM balance the intense pressure of short-term market speculation and that wild stock volatility with the long, disciplined, perhaps less exciting road of actually building a durable, profitable SaaS company in the clean energy space? That tension seems central to their story going forward. Thank you for joining us on this deep dive. If you found this valuable, please do remember to subscribe, like, and hit those notifications for the deep dive. We look forward to our next dive.